So what's going on, everyone? This is Knowledge Beckham, and you are here again, episode number 3 of season 3 of the Droppin Knowledge podcast on our new network, the Droppin Knowledge Network. And so if you are not following us on social media platforms, you can follow us on Facebook here at the Droppin Knowledge Network. You can follow us on Instagram at the Droppin Knowledge Network, as well as YouTube, Droppin Knowledge, and no G on that Droppin, just Droppin. But again, our goal is to every week we come to you with different shows, more content, and it's all about education, empowerment, inspiring those individuals. A lot of this information is information that has escaped us over the years, but we are dedicated to bringing this information into you. And so today we have a tremendous episode. We actually touched on life insurance in season 1 of the Droppin Knowledge podcast. And so this is kind of level 201. And I got two amazing gentlemen here today that are going to kind of walk us through, financial planning, wealth building, legacy building, et cetera. And so super excited to welcome Jawaan Avant and Allan K. Bell to the Droppin Knowledge podcast. Welcome, gentlemen.
Thank you, Knowledge. Thanks for having us.
Thank you, Knowledge. Thank you for having us, man. Thank you for having us. I'm excited.
Absolutely. My pleasure. And so let's kind of kick things off. So, if you hear the term, some people may not have ever heard of the term fiduciary or a financial planner, or not know what value does that individual bring to me. And so, Jawaan, why don't you start things off and give me what your perspective is in terms of what you do and how you help people. And then we'll have Allan, kind of, who's been in the business for many more years, kind of share his perspective as well.
Okay. Well, the way we help clients, we get to know them more on a personal level. We take a comprehensive approach to really getting to know our clients. We look at things beyond money. So being a fiduciary and making the recommendations, we have to spend more time to really learn our clients, and we held to a higher standard of that knowledge for our clients.
Got it. Okay.
Mm-hmm. Yeah.
And what would you add to that, Allan?
Yeah, not much. I think the fiduciary responsibility that Jawaan touched on in terms of the higher standard is, he's hitting the nail on the head. What I would add, I suppose, is the fact that the barriers of entry knowledge are very low into our industry. Okay. So you can get, I wouldn't say it's simple, but it's relatively simple to go out and get a license and start selling life insurance.
Okay.
So I think it's critical in terms of the point, and I appreciate you bringing it up to make it clear to your audience and to the people that we serve that there is a differentiation between someone who can sell you life insurance and someone who's a fiduciary and is held to a higher standard and has to get to know you so that the recommendation they give is appropriate.
Got it. That is well said. So to dive a little bit deeper into that then, so fiduciary, it sounds like more responsibility. So I'm going to assume that that's more training for you, more education. What's the difference, right? How long, if I wanted to go start selling life insurance, how long does that take me to get that license to be able to do it versus if I wanted to be a fiduciary, what additional steps would I have to take?
Great question. Jawaan, you don't mind if I answer that?
Go ahead.
Yeah, I would say to sell life insurance, you take a state-based exam, probably, I'd venture to say at a high school level competency, right? Pass a state-based, state regulated, proctored by the state that you're in, pass that exam and you're able to sell, term life insurance and whole life insurance. And you need to be licensed, investment licensed to be able to sell what we call universal or variable life insurance. But if it's not investment related or what we call correlated with the stock market, having any investment component to it, state proctored exam. It's fairly simple. Now on the fiduciary side, that comes with, again, a lot more responsibility. You aren't just basically transactional and selling a product. Now it's like going to the physician. If I don't really know what's wrong with you, I don't know where the pain is, I might just sell you something that is, really, really pain suppressing across the board, but I don't really treat the problem. You know what I mean?
Right.
And so fiduciaries are held to a standard that they need to really figure out what's going on and make a recommendation that's specific to what's happening in a person's life so they can be supportive and be helpful. And then beyond that, again, you get audited on a regular basis. Typically, fiduciaries are a part of a organization. You don't have to be, but typically you have that infrastructure and that compliance component. And, FINRA will come in and audit you. So there's a lot more. Not that we should always be looking out for our clients anyway, but if you're going to have your files audited and there's going to be someone who wasn't in the meeting with you and the client reading through your case notes, that's a little bit different when you're sitting down talking with a client, just like a doctor does when you leave the doctor's office. They go through and put some notes in place for whatever you talked about. So it's a completely different experience. I'll give you a quick example. There was a DOL, a department, basically a labor, Department of Labor, DOL expansion of fiduciary responsibility that we went through about 2 or 3 years ago. And that happened, knowledge, because there was, in basic, it happened for a lot of reasons,
Okay.
but it was a significant oversight by the government in terms of policing our industry, because what had happened on a smaller level was a lot of people were selling, people in our industry, selling annuities to older individuals, people who were retiring. And those retirees were buying annuities in a brokerage environment where there was no fiduciary responsibility. And the advisor didn't have a responsibility to come back and stay with that client and manage that client and review with that client. They basically just sold a product, and those products weren't always suitable. And so, you have a older person, they make a big check. They write maybe a 7-figure check for an annuity, and maybe it's an expensive annuity, and that may not work out well for the client. And then, of course, maybe there's a market correction, significant market correction after they make that investment. But again, the person that sold it didn't have a responsibility to stay in touch.
Got it.
That makes sense?
That makes perfect sense. So, I think oftentimes, there's a couple things at play, right? So one, just getting individuals to think about tomorrow, right? In the future, when it comes to, life insurance products, et cetera. But then also I know that there's different types of life insurance, right? And so, Jawaan, kind of talk to us a little bit about what are some of the products that are out there for individuals that, hey, you know what? I need to get me a life insurance policy. What are some of the products that are out there that you might talk to a client or an individual that's interested in life insurance about?
Okay, so our first step is to always come with education. So our main thing is to educate them on the two different types of life insurance between term and whole life. Now, term, is similar to renting. So it's a need, like some people to protect, they want kids to go to college, or they might have a home, or just to protect that need. So it is a purpose to have term, but we understand that we will need some form of life insurance even at the end. So the way, term is designed, that's how the insurance companies really make money, is because they kind of base, your life expectancy to you outlive the term. So of course, it's very important to have that need and cover that need, because life insurance is the most best way to transport generational wealth, basically to move money across tax efficient, because the death benefit is received tax free. So speaking to a client, educating them on that type, and just trying to find out what their need is, and then we can address that need. Now, there are benefits of owning whole life. There are benefits of owning whole life, and me having a contract with Northwestern Mutual. We have something called convertible term. So at some point, it's cost efficient to have term, and sometimes that's the best thing for that client. And then down the road, we can look at other options if we want to move over just a small bit of that term into whole life, just so we can have something, even if we live to 120. That's something that's important, and that we to know about life insurance.
Well said. So I'm gonna ask a follow-up question. So, and you tell me if this is correct or not. So term, let's say I don't have a lot of money, right? But I got a couple kids. I want to put some value on my life. I want to leave something behind. So one, if I pass, they can bury me properly. But then also I want to leave some sort of dollar amount. That is and I don't have a lot to spend, right? I want to do $20 a month, $29 a month. Is that what a term policy is? And does it have, and when I sign up for a term, is it until I pass, or do I have to at that point in time say term, a 20-year term or a 40-year term? So talk to me a little bit about that, Alan, in terms of my thinking there, and correct it or add to it, or whatever you see as the best way to respond to that.
No, that's spot on knowledge. I think what we find where I would start, like Jawaan said, is education. I'm telling people it isn't about which one is better than the other. They both are good because guess what? We all pass away. So both are good. It just depends upon what your circumstances are. What you described was an ideal circumstance. You don't have a lot of cash, not a lot of surplus, we'll call it, at the end of every month, but you are a loving husband or a loving father, or maybe just a caring business partner, a responsible business partner. And you want to make sure your partner in your multi-million-dollar business isn't left with that mortgage or left with that responsibility in case something happens to you. It's a significant tool in that case too. But it is affordable. Term is more affordable. But like Jawaan said so well, not all companies have convertible term policies. So if you can secure something that's term and affordable, and know that the policy has an ability to be converted into something that is permanent, that's the best way to give yourself multiple options down the road. But you're right, they both will be passed through your estate tax-free if you pass away prematurely. That's a good way to get a lot of coverage the earlier you are, and get as much as you can get while you're healthy, because like Jawaan said perfectly, an insurance company is not a good one, a solid one, a financially solid one, is not going to sell you a term policy if they think you're going to pass away before the term does. They think you're going to die before the policy expires. So that's how they win. They approve it because they think you're going to outlive it. So definitely, people, again, both are great, but don't buy something and then get complacent with the affordable premiums, and then you outlive it, and now you're 65 years old and you have nothing. So what you described is perfect. And like Jawaan mentioned, we know we're going to pass away, so have something, at least a little bit, that can at least take care of your needs at passing, that's permanent, and that will be here as long as you are.
So let me make sure that I heard, or I don't know if I heard this or not. So when signing up for a term, there is a period of time that insurance policy is good for.
Yes,
it's
sir.
Not just as long as I pay it. There's an actual date on it that this term is over.
That is correct. But here's the caveat with that knowledge. It isn't as if, the insurance companies are, they're unique. I mean, you say you have a 30-year or a 20-year term policy.
Okay.
And you turn in that 20th year, you're still paying whatever premium you were paying from the first year. So it doesn't just automatically lop off and fall off a cliff. But let's say, as an example, you've been paying $200 a year for $1 million term policy.
Okay.
Well, in that 21st year, they don't necessarily say it's gone, but your $200 a year just goes to $2,000 or $3,000. So effectively, you're like, okay, well, it's kind of gone because I can't afford it.
Right.
Or again, maybe it just maybe you have to. And some companies will say, okay, you can have not pay the $2,000 to $3,000 as long as you qualify medically, but it's definitely going to be more than the $200 you were paying, right? So the concept is to protect yourself and not have to requalify medically and go back under the underwriting process and be able to still buy more without having to prove your health, only based on your age. Do you understand?
I do.
Yeah.
Got it. So I have something. This is obviously still within the space that we're in, but it is a question. I mean, it's a thought that I had, and I have the right gentleman on to be able to ask this question. And so when you talk about just kind of, we're all in Chicago, and you talk about kind of some of the ills of the city, and you talk about some of the rougher areas and neighborhoods. The one thing that I didn't realize is that I knew that you had to get a medical exam, et cetera, but I don't know if I knew it was as much scrutiny that is put into approving a policy. Would it be more difficult if I'm a and this is no shade to any neighborhood, but let's just won't call a neighborhood, right? But just in an area in Chicago, high violence, high crime, and going through that process, is it possible that I don't get approved based on my location, where I live, etc.?
I believe it is. I believe it is. I've been doing this 15 years and I've never been able to prove it. But what I will tell you, just to answer your question in a different way, and I'll say not even answer your question, will be agreeable with you in a different way from a systemic perspective, is now some companies' knowledge are now including in the underwriting process a credit check.
Oh, wow.
You know what I mean? So I think, with regard to redlining and with regard to systemic racism, I can't prove it, but I think that would be, I would, let's put it this way, I wouldn't be surprised, right? If you make every other facet of an application and an applicant the same, but just change the address, let's just say I would not be surprised if you have maybe it's not declined, but you might get rated. I just think that that's a legitimate statement. I can't prove it, but I think been going through and now I'm dealing with situations where people are getting declined for all sorts of reasons that haven't always been the case. We weren't always able to buy life insurance.
Wow.
As Black people. That's why I'm so appreciative to you for doing this. I mean, it is all about education. It is all about education. And 200 years ago, I mean, some of these companies have been around for almost 200 years.
Right.
Right. And, so just say that 180, 170, 160, 150 years ago, we all are well aware we weren't always able to buy life insurance.
Right.
Right. And the graduation or the growth on that was, okay, well, now we'll let you buy a burial policy as a population, as a people, because it got started to get expensive. But those weren't whole life policies. Those are $5,000 term policies.
Right.
Right. So I mean, that whole maturation, it's so important for us to understand that. And then, of course, when we get into a situation with a planner or an advisor or someone that's just out there, peddling life insurance, as we get older, we factor in the way that we eat, and we factor in the way that we exercise or don't exercise, or just the things that come along with our heredity, and then we let a policy lapse as we get older.
Right.
Right. So part of what I want to share with you and your listeners are, that term, that even if it is term, that policy has to be paid like the water bill, like the light bill. I mean, it's got to be paid.
Right.
It shouldn't be it's not a luxury.
Right. Yeah, makes sense. Thank you for that. So, Jawaan, how long have you been in this? How long have you been in this business?
I've been in the business for almost 2 years now.
Almost 2 years. So, if you had to give me one thing that has just I've been the most eye-opening to you in your 2 years in the business, what would that be?
The miseducation, just kind of meeting people and just kind of hearing, what their thoughts are about life insurance, and just kind of getting into our community and just kind of figuring out a lot of people. Some, they talk about wanting more information, but when like the information is presented, it's sometimes just like fighting tooth and nail to get the information down, for them to understand, how important it is, and just realizing that it's a lot of things out here that we've been told, even about life insurance. Is even within our community, people tell us, just buy term, invest the difference, or do different things, or you can self-fund. Like, it's all these different other ideas out here, and I just learned that it's a lot more people that need this information than they allow themselves to get.
Yeah, I think that's a great response, great perspective. As you both know, I'm in the financial literacy and credit restoration space, and that same miseducation is out there, right? I don't need credit. I don't mess with credit cards, right? Just things that it's just bad information, right? Just bad information that was passed down. And I tell people, do you know that you can't maximize your credit score without a credit card? Like, that's 30% of your score is based on how you manage your credit card debt. If you have no credit card, you have no debt to manage. And so a huge pillar and how your credit score is calculated, you're not playing the game. 10% is based on your mix of credit, having revolving accounts, which are credit cards, and installment accounts. You don't have any revolving accounts. There's another area you're losing points. And so when you wonder why you can't get above a 615, but you're still trying to buy a house, you're still trying to buy a car, you're just paying much more interest. And you're right, breaking through that education piece is huge. And so I appreciate that. Allan, I want to change gears a bit, since I just had the great experience of working with Jawaan and you in terms of setting up a policy as well. And I don't mind my audience getting a look in. So from your perspective, Jawaan reached out to me. I work with you guys both. As you asked questions and got to understand, talk me through that process because I thought it was such a strong process that a lot of people need, because you were able to walk me through my life and kind of walk me through taking some initial steps in terms of putting a good plan in place. Talk about that process and how you see that and how you kind of walk your customers through that process.
Thank you. It's an awesome question. Thank you so much for that. Back to what Jawaan mentioned in terms of the things that he's learned, I think a lot of it is, we've been burned. It's kind of like any relationship. When you get burned, or you hear that your uncle or your grandfather or your father got burned, and now they teach you lessons based on what happened to them, we carry down this misinformation. So part of our process knowledge is, like Jawaan mentioned earlier, as a fiduciary, I get real transparent with people. I tell people my story. I'm very comfortable with my story. And I think that helps, build the trust. I also am very passionate about the work that I do, because I literally today was helping a client. Guy has a ton he does very well, and he's trying to help a family member who isn't doing very well. And she is in the underwriting process knowledge, and she passes away during the underwriting process. Most carriers would be like, done. Northwestern's going to pay that claim.
Wow.
They're going to pay that claim. So that's like sitting in a boardroom full of all, people that don't look like us, and being a fly on the wall and seeing, okay, these are the types of companies you want to associate yourself with. And this is a type of strategies that are being, employed, and this is how we can win. So part of that is what we call the fact-finding process. So one, I understand my audience. I meet my audience where they are. I try not to talk over their head. I try to get really sincere and direct with my audience. Two, I'm very transparent. I don't have a problem sharing my story. Three, I take Jawaan and I take the approach of the recommendation very seriously. And yes, sometimes we'll encounter somebody who's a little more protected, but I explain why it is I want to know. And I'll explain and I may share my story as to why it is I want to know about your family, as an example. Well, Allan and Jawaan, I don't really want to talk about my mom or my dad or my sister or my brother. I kind of want to keep them out of it. Well, I'll tell a prospective client that most of our clients, they're the ones that get the phone call when the hits the fan. Right. So you might, as my client or as our client, you may need to have a little more reserve there, more cash reserve than what you read in a book, because of what you're sharing with me about your life situation. Maybe you have a parent or a niece or a nephew with special needs, or so if you get deep and you understand what's going on. In my engineering background, and I was an engineer for 18 years. So, for me, I love to get analytical, and I love to be deep and technical. But and then at the end of the day, to finish answering your question, when I come back to you with a recommendation, I'm restating what you told me. And therefore, it's less of a sale. I'm supporting you in the area of making a purchase. I'm not selling you. Does that answer your question?
That does. That makes perfect sense. So, Jawaan, you've been in for a couple of years. You talked about some of the things that you're having to deal with in terms of the education piece, et cetera. Share a success story. I'd love to hear a success story that you've had. Other people that are listening may identify with this as well. And for anybody that's listening, whether you're listening now or you're listening later on a replay or the podcast, et cetera, you can go back. We have this on YouTube. And so I'm going to drop their contact information as well. So if you're in the area or the state of Illinois, because I think it's licensed by state, et cetera, you can definitely reach out to these guys for more information. If you're watching this live on our Facebook feed, you can feel free to drop questions in there as well. And if I can get to them, I will have these guys tackle them as well. But Jawaan, kind of a success story that you've had with a client. Love to hear about that and what that looked like.
Well, it's always a success when we can get a client to, take action on, doing something that's going to, put themselves and their families in a better position. So, walking through a person who, like I say, let's just say if the success I had with somebody who, they didn't want to hear about financial planning. They had no thoughts about, they didn't want to learn anything about it just yet. They wanted to just talk about stocks and bonds and stuff like that. They didn't really want to get down into how we protect ourselves, how do we build that strong foundation. But I was patient. We're not in a position where we try to force clients to move on our time frame. We moved to the time frame of them. So I was able to, spend quite a few different meetings, different approaches to really get that understanding. And when they finally, put something to protect their income and to put some life insurance in place to protect their family, that was a win for me. Just because at the beginning they didn't necessarily find the value when I was first introducing these new topics, but now they're at the point where they're telling more people about it, and I feel like that was a success. Each one teach one mentality.
Absolutely, I love it, and be forever grateful as well that you stayed persistent and consistent with me as well. I know that you reached out to me just cold, right, via LinkedIn, and it was something that, and you probably run across it, was something that I knew that, hey, you know what, I need to take the next step, but we're so busy in life and doing these other things that we feel are building for ourselves as well, and we may be missing this component. And so, again, just appreciate the work that you all did. And so with that, Allan, if you don't mind, if you recall my situation and walking me through, this was something that, probably honestly, I didn't hear about until probably a couple years ago, because I always just associated life insurance, death benefit, right? Having money so I can get buried and I won't be a burden on anyone, et cetera. But I didn't understand or know about this growing, this growing your money, right? The tax benefits to growing this money, and this type of policy that has been used by so many that don't look like us for years. Kind of talk about what that product is, what it's doing, what's happening.
Thank you. Yeah, I think in the context of a financial plan, that product or that strategy can be super, super helpful. Now, on its own, the product can be super helpful. But I want to share, in answering your question, answer that question in the context of a financial plan. And if I do that well, what I'll start with in my mind is the concept knowledge is the concept of taxes. And if I can start with that concept, which we all know we pay taxes.
Yep.
With the first job you go get, as soon as that FICA comes out, you're like, well, I know I worked a certain number of hours and this is what I'm getting paid per hour. And you look at your check and you're like, wait a minute, that math doesn't work, right? So when you're 13, 14, 12, whatever age it is, you go out and do that. Now, if we all can agree that taxes play a part in everything that we put together with regard to building wealth. I don't care if it's real estate, stocks, bonds, mutual funds, a business, whatever it is. If we can agree with that statement,
right,
then I can take a client to the place where we say we want to minimize that, or at least be strategic or be effective with regard to that variable as it relates to building wealth. And then maybe there's an issue of estate planning. Right now, I think it's 2020. I think the death tax, the estate tax exemption is about 22 million, something like that. So folks don't know, like you said perfectly. A lot of people don't know that there's an exemption. It might be 2 million, it might be 20 million, but whatever it is, it's an amount of money that gets to pass through your estate when you pass away, tax-free. And if you're worth 50, as an example, if it's 21 million and you're worth 51 million, well, now you got it. Now you have some money that's exposed to the death tax, or to the estate tax when you pass away. And I don't know about you, but I think the person, they got lucky, or maybe the person worked a little bit harder, but the person that's worth 22 million and they get to pass through their estate, completely tax-free, versus the one that's worth 51 million. And now they have 30 million exposed to 50% of taxation. That's pretty painful.
Yeah.
And so I don't think that's, equitable. So we will help somebody that's worth 50 million to minimize that exposure. Now that's, again, that third leg of the tax concept and tax conversation. But there's also, that's when you pass away, but there's also an accumulation factor, right? And there's multiple ways. Like some people knowledge, my age demographic and a little bit older than me, everyone's familiar with what a pension is. Our children won't even be familiar with what a pension is, right? In terms of how it works. 401ks, right? All those things have tax implications. Well, life insurance happens to be, and it depends whether it's variable, universal, or traditional whole life. It happens to be a component or a tool that you can accumulate wealth. You can accumulate value, cash value in it. And we don't have enough time to explain the detail, but I can just say, as a tool, you can accumulate wealth within the contract. And yes, you can access the cash in the contract to be able to do whatever you want to do with it, tax-free, with no obligation, no penalty, no regulation. If you do it well and if you do it early enough, it can be very, very, very significant when you look at whether it's retirement planning or whether it's business planning or if it's just paying for college or if it's buying that second home during retirement. I mean, it can be accessed for anything you want to access it for. But it has to be in my opinion, in the context of a financial plan, and it can work really, really, really well.
Excellent, excellent. So I know during our conversation as well, we talked about, you asked me, kind of what I was putting into my 401k, right? And a lot of folks, again, that don't want to get into the weeds, you say, I got a 401k, I'm dumping money into my 401k, but you're not really watching your 401k, right? And you just had me look at it and start to think about, is that, how much, what am I putting in comparison to what the end game is? Kind of talk about when you're doing that, walk us through kind of the logic.
Thank you. And I hope this is effective. It's been effective for me, but the first thing I'll do, knowledge, is I just want to find out who told you to do that. You know what I mean? Oh, I'm walking around and people, I'm maxing out my 401k, and people kind of carry it like a badge of honor. Well, I'm maxing out my 401k. Oh, well, by July or August, my income goes up, and I just end up paying extra tax because I don't put all I can put into my 401k, and they almost carry it like a badge of honor. But I go right to the core and say, well, who told you to do that? Where did you learn that? And again, try to meet people where they are, and then once I can help them to articulate for me that they really didn't, they learned it kind of through osmosis or over the water cooler or whatever. And then I help educate them on how that thing works, right? In terms of taxation and how the government works and how the hooks work, where you can't touch it before 59 and a half, and you better touch it, required minimum distributions. If you don't touch it, I mean, what if I told you, knowledge, that you came to me and you said, Alan, I need $2 million. And I said, no problem. Well, hold on, before I cut this check and give you $2 million, are there any terms you want to talk about? And you said, well, yeah. What are you going to charge me? You're just going to give me $2 million for nothing. And I'm like, yeah, you're right. I'm going to charge you interest. And you said, Alan, well, how much are you going to charge me? And I said, knowledge, I'm going to tell you how much interest I'm going to charge you when you pay it back. I'm going to wait until later to tell you how much I'm going to charge you to borrow this money from me. Would you borrow it from me?
Not at all.
Why not? I'm a good looking dude. We both brothers. Come on. Why wouldn't you do that? Right. So that's what you do with your 401k effectively. You don't know what tax you're going to pay on the 401k 20, 30 years down the road. Now, I'm not saying don't do the 401k at all, because there is a tax benefit from doing it year to year. I'm just helping people to understand they're putting all that money into something that they really don't understand how it works. And when you're 72 now, used to be 70 and a half, when you're 72, say you have a really big windfall in your life at 65 or whatever, you sell a business and you don't need the 401k, you don't need the money in the 401k. Maybe you want to give it to your kids. Uncle Sam's going to make you take it out at age 72 because they've not gotten any tax revenue from it. So as people understand, now some of this may be fundamental for your listeners, but a lot of folks just don't understand this. And so as they understand, again, how it works, then you can figure out where it fits. I'm not going to tell you it doesn't fit at all, because it does have its place. Right. But maxing it out isn't, in my opinion, isn't appropriate. So, yeah, that's how I think I had a similar conversation with you. And then as we figure out what the tool is, what the animal is, then we can figure out where in your life and where in your financial your plan it fits. And then, of course, we talk about, again, the concept of, as you get older, we typically become a little more appreciative of safety, safe money,
Right.
right? I don't want to take as much risk as I get older because I don't have as much time to be able to recover. And so that's where the investment conversation has to come in. Jawaan is a killer, man. He's just passed 2 of his investment exams. He's like a beast. I can't get the kid to stop studying. So we've got to understand that a financial plan doesn't just include life insurance. So in our conversation with you, you're very astute as it relates to investments. And so we were having a good collaborative, you were an educated consumer discussion around investments. And so when we think about investments and risk and portfolio allocation and portfolio construction, again, the life insurance has a significant place. It doesn't do everything, but it has a significant place. So that's where something, as you use the example of a 401k, is not compared to, I was going to say compared to, but that's a wrong word, because life insurance really isn't an investment. It can be if you include, if you have a variable or universal, but it can show up. What we like to recommend is that whole life, where it shows up strong and it's a safe hedge and against volatility. And if you're retired at 65 and the market drops, you can pull cash from something that isn't subject to the market and will never go down. And the last point I'll say is all whole life insurance policies are not, just on that question, are not the same. So please, for your listeners, it's like, anything you purchase, there are the best people, there are companies that do it the best, and there are companies that don't do it very well. So all whole life products that are offered by all companies are not created equally.
So in the whole life realm, what do we talk? Are there 2 or 3 products? Are there many more kind of, people know term, whole term, and I know that's that's not it, right?
That's right. There's multiple levels of term. There's multiple types of whole life. A universal policy, universal whole UL policy, all those types of policies are forms of whole life. They all accumulate cash, but some of them are tied to the market, some aren't. So, great point. Again, great point. There's multiple kinds of whole life, and there's multiple types of term. Like they have the term now where you can return on premium term. They've got the convertible term. They've got the, just different types of term life insurance. So yes, you've got to sit down with someone who's credentialed and who can talk about the different types. And you're right. Yeah, it is a lot more complex than just 2 types, but mainly there's 2 types, but there's variable on both sides.
Got it. And so as we get ready to wrap, I know these sessions can be 5 hours long. There's so much information. They literally were, right? Because we had multiple calls, and every call you guys were educating. And so, for anyone that is listening and you don't feel like you have what you need in place, I would strongly recommend reaching out to these 2 gentlemen. I'll drop, for those that are watching this on YouTube and Facebook, I'll drop Jawaan's contact information here. Him and Allan work together. And again, I highly recommend them. I think they do a great job of educating and walking you through exactly where you're at. And where I want to kind of close at is I have a daughter, right? I have an adult daughter. I have a brother. I have a living mom. And so one of the things is, I came to you guys and I was looking to take care of me for my daughter and my grandkids. But you kind of had me take a step back. Right, in terms of his mom doing, what his brother doing, and kind of more from a family perspective, which I'm not sure how many of my listeners think about it that way, right? We take the first big step, which may be us, but then there's a strategic way if you're looking at it from a family perspective. Kind of talk about that as we get ready to wrap.
I think you hit it perfectly. I just got home from taking care of my 86-year-old mother. Life happens to us. So, and again, as fiduciaries, like Jawaan said perfectly, I'm just not doing a good job for you if I don't understand all the things that are going on in your life that you care about. And so, can a parent become a distraction? Not distraction. It's almost disrespectful to say that, but can a parent end up being a liability or a burden, or all those words don't seem to fit. But that's ultimately what can kind of happen when they need you, but you're at the same time trying to save for college or trying to build a business or what have you. So you are right in that regard, and in that for us to be comprehensive and for us to really love on our clients and do the best thing for them, we have to understand the entire situation, and then let the client, if you're not aware, if I make you aware of the fact that someone could be a potential risk to your wealth that you're building, and then give you the option to talk about it and maybe mitigate that risk and talk about options or solutions, and then you say, no, I'm informed now, but I just don't see the need and I'm okay taking the risk. I've done what I'm supposed to do. But if I don't help you recognize the risk, then you're missing something. And what I have a fear of is something happening down the road, and we didn't do a good solid job. Jawaan and I are not employees. We're contractors. So we can gain access to the most, in my opinion, pound for pound, the strongest financial security firm in the country. But we also can help clients with Prudential, New York Life, Mass Mutual. We can go anywhere. So again, that makes me really sensitive to the people that we're getting in front of, so we can do a good job. So I think you're right with a daughter, and I mean things that someone that said to me what you just said, I would be thinking the first thing I would say, knowledge, and I'm not going to go personal with you, but if somebody said, I have one parent living, I've got a daughter, grandchildren, and a sibling, and so on, I'd want to know how that parent passed away. And I'd want to know if that parent passed away over a length of time, and did the family have to scramble, and did maybe one child, or maybe one of your siblings have to quit work to take care of the parent? Like, I want to know how that happened. And then if there's an experience there that we can tap into, and for you to say, yeah, that was difficult and it kind of set me back. I know I needed to do it. Maybe I moved my parent in with me. Maybe I sold a piece of property. Maybe I bought a piece of property for them to live in. Maybe I had to spend extra money for a caregiver, right? I want to know that, because now I'm going to say, okay, that's a lesson learned. I couldn't have taught you that, right? Now, thinking about yourself, single, good-looking guy, maybe you want to get married, maybe you don't. Let's make sure that you're not going to be dependent upon your daughter down the road.
Right.
See where I'm going with that?
Yes, sir.
That's how we try to fact find and make sure we help people understand what some quote unquote hidden risk might be, and then have a comprehensive conversation about how you might mitigate that. And again, if we talk about it and you decide, okay, that's never going to be me, well, then at least I've done what I could do.
Right. Well, gentlemen, I appreciate this. I knew that it was going to be tough to nail you two down. Two of the busiest men in Chicago, and I appreciate everything that you all are doing. I have a strong belief is that everyone hopefully is fighting the fight to empower our community and our community. The work that you all are doing in the space that you're in, I think the work that I do with the credit piece, so many of us lack this information, and you can march and you can do no knock against anything, but the piece is the piece that has shaped us so long that people have kept away from us. I want to salute you both for putting in on a day-to-day basis. Appreciate you all for being guests on the Droppin Knowledge podcast. This live through Apple, through make sure that you guys check guys out, reach out to these guys, as they absolutely can help put you on the right path. And so thank you both again for appearing on the Droppin Knowledge podcast episode 3, season 3, another classic in the book. Thank you for that you both dropped tonight.
Hey, thank you, Niles, for doing this, brother. A shout out to you for taking the time out. We love you for what you're doing, man. Listen, it is we can't do it alone, brother. So I mean, really, shout out to you for all that you do. I mean, what you're doing is huge. So thank you so very much. We appreciate it.
Thank you. And again, continue to support the Droppin Knowledge Network. We have multiple shows. You have the Droppin Knowledge podcast. You have Building While Black, which spotlights Black entrepreneurs and every stage of entrepreneurship. Also, we have Empowered with Shonda, which spotlights African American women that are doing huge things out here. So continue to support the network. Follow us on all social media platforms, and make sure that you tell a friend. So thank you. And until next time, peace.
All right, brother. Good night.